Hey everyone, it's Lawrence Mack here, real estate broker out of Mississauga and founder of Real Estate Rookies. And today we're talking about finances, taxes, and the PREC. This is pretty important in terms of just at the end of the day, everything is about, I guess, making money, bottom line kind of thing. So these are things that you should figure out in terms of your business. I'm just going to go through some tips and hopefully they help. So first one, we're talking about who am I? So for your information, I am just a realtor. I am not a CPA. My background though is in business. I've never had a job. I've had only owned businesses myself. My parents have owned multiple businesses. I own multiple businesses. So everything I have to say to you has to do with the point of view from a business owner and not as a tax attorney or CPA or that kind of stuff. So when you need that type of advice, I highly recommend you talk with the CPA and get advice about that. But I'm just going to give you high level, some kind of tips on how to like make or save money. So the first thing would be sole proprietor tips. So if you don't know, everyone here is most likely a sole proprietor. That's just like the first thing that you do in terms of when you register to become a realtor. You can't really get a corporation, at least previously. So it's a business number. So I don't want to get that much detail into the specifics of like the tactical things, but like you're going to get a business number, you get like an HST number. If you're going to have to pay, say, income split, whatever it is, then you're going to need a payroll number. You're going to need all those type of things to talk about your taxes and then send them to the CRA and that kind of stuff. So that's setting up the sole proprietorship. So the first thing I recommend always is to get a separate bank account and not to mess it up by putting it into your personal bank account. So get like a separate bank account for just real estate, and that's where all your transactions go in and out of. That'll make your life a lot easier in terms of the end of year or end of quarter kind of tax reporting, so that you just have to print out the statements and it gives you a better idea. If you start mixing it up with your personal, it gets really, really sticky. It's hard to unwind everything about what, which is real estate related and which is personal. So just keep it separate by a separate account. I also recommend having multiple separate accounts. So for example, you would have one for checking, you have one for maybe savings, and you have one for taxes. The recommendation, at least for my CPA at the time, was to maybe allocate 35% or 30% of every check that comes in. So if you have a check that comes in for $100, you take 30% of that and you put it into the separate tax account. That way, when the time is ready, you can pay out of the tax account to pay for your corporate tax, to pay for your CRA taxes, to pay for HST taxes, all that kind of stuff. That way, it's a lot easier. Some people, let's just say you got $100 of commission, $100 plus HST, you have $113. And now you think you have $113 to spend, but you don't, because 13% of that is HST. And out of the $100 there, a certain percentage of it is actual taxes that you have to pay. So a lot of people forget that. And then when tax time comes, they have a big check they have to write. And that's usually very daunting. And a lot of people aren't ready for that. So I recommend to get a separate tax account that whenever a check comes in, you just put it there. And also, if you have a separate savings account, not only do you get interest, which usually is minimal, but it helps protect you from the bank point of view, because if you only have one checking account where money comes out of, you don't have as much money in that checking account. So in theory, if you had some type of Interac scam or something like that, you're not going to lose as much money, hopefully, because all the money is like in a separate account, which is like the savings account. So that's my recommendation for getting a separate bank account. So both get a separate bank account away from your personal account, and also do different ones, such as the three which I recommend is checking, savings, and taxes. But again, however you allocate that is up to you. Second thing I like to do is get an all-inclusive bank account. The last one I used was a TD. I have one now, Scotia. I actually deal with like all the major banks. So if you have a question about it, happy to answer it. The last one I did for TD when I started my real estate career, that one had a good all-inclusive account. Typically speaking, it's about $5,000 minimum balance. If you could pay that, that's great. You keep it in there, and then it'll take care of all of your expenses in terms of the bank account expenses. So it usually gives you a security box. It usually gives you the checking. All the inclusives typically will give you free, like maybe certified checks or bank drafts, that kind of stuff. And that one's important in case you need it for either real estate transactions that you need to write a certified check, or often for us, you need to put in a deposit for the freight elevator so that you could like stage an apartment in a condo, that kind of stuff. They usually want like a certified check. And so if you have the ability to get a free certified check, it helps, versus if you get an account where you have to keep paying $10 or $15 or whatever it is to make a certified check. That's the advantage with the all-inclusive. Otherwise, some all-inclusives, for example, TD gives you some type of car help, but I didn't find it as useful because apparently it wasn't as good as CAA. So I also have CAA, but I thought I could maybe put them together. I hope that the Auto Club could have replaced CAA, but apparently it doesn't. Look into it, but it didn't quite do that. So don't want to say anything bad about TD or the Auto Club, but anyway, that's what that situation was about. Third, what I like to do is I like to fund the business. And what that means is when I started out in real estate, I actually just allocated an amount of money, let's just say $10,000, $20,000, whatever it was, and put it into my real estate account. You can do the same thing in your real estate account, set up a line of credit or just move money over. But the idea is that now the business account has a certain amount of money and that just funds your real estate career. So you don't have to think about where the next, how are you going to pay for the next amount of expenses because you have an amount budgeted, which is, for this year, for example, I'm going to put $20,000 in this account. All of my RICO fees and insurance fees and TREB fees, they all come out of this $20,000, all my car expenses. Everything comes out of that fund. That way you don't have to think about it because it just comes out of that fund. So I found that pretty easy. In my first year, although I didn't make that much money, I didn't really touch that fund much because my expenses were pretty low. All things considered, they're pretty low. So like I didn't really touch them. I touched a bit, but not that much. My first transaction happened within the first week. So it was pretty quick when my cousin, my first two deals were my cousin and my other cousin, and after that it was like nothing else for the rest of the year. So the first week was like, oh, this is easy, and after that it was less easy. But with the initial deal or whatever, there's some commission money coming in, and then it just helped fund it for the rest of the year. So that was good. Fourth, get a CPA. Highly recommend this. If you don't have one, I can recommend one. If you want to do it yourself, that's fine too, but I highly recommend getting a CPA because it's just the cost of doing business. They'll hopefully keep you out of trouble. A good CPA will be worth more money than you pay them. So if you pay them, round figures, if you pay them $100 and they make you more than $100 because they help you with like deductions or to get you out of trouble from an audit or something, and then it's worth more than $100, then that CPA was worth more than $100. It's not about the expense of the CPA. It's hopefully they can help you make more money because it's not just the expenses you're trying to reduce, but sometimes, you can make more money in different ways. So my CPA has gotten me out of trouble many times and given me advice a lot in terms of things that I can and can't do. And so I highly recommend that. But if you want to do it yourself, I think it's fine, maybe for the first year, I guess. But I really recommend from a business point of view to go forward and to get a professional help for that. And lastly, keep it legitimate. I mean, you can make really, really gray decisions on what you want to do with your taxes and stuff. It's up to you. At the end of the day, the CRA doesn't really have a statute of limitations on when they can go back in the past and get taxes. So, for example, even when you're just talking about, so this isn't about real estate in general, but if you're talking about the amount of money that you made or for when you bought or sold your house, where you're supposed to put it on your tax returns now, there's nothing stopping the CRA from coming back 10 years from now and just saying, hey, you owe us tax on that. And that kind of sucks, but like that's what they can do and you can't really appeal that. So you never know how far back they can go or what is now, what might be kind of legitimate or gray now might be totally illegitimate later, and then they can go back for taxes plus penalties. So I would highly recommend just keeping it legitimate. The number of sole proprietors and realtors, but sole proprietors that get audited is quite high. I think my CPA said it was sometimes like 3 times the amount, but the actual, that's anecdotal. I don't know what the actual statistic is, but there is a higher chance of auditing because it's a sole proprietorship. So just be careful about that. Any questions about sole proprietorship over here? I'll give it 2 seconds and we'll move on. Okay. Next. There we go. Okay. Profitability tips. So we're here. So here's a couple of just tips that I would recommend in terms of profitability. It's not always about reducing expenses, although a lot of times it is. Like you got to think you can't save your way to riches, right? The other way to riches is really just to get more sales. So you can't save your way to riches, but it does help. You want to minimize it so that you're not just wasting money. So the first one, which comes from MREA, which is a Millionaire Real Estate Agent book, which I highly recommend getting. That's basically the Bible that every realtor reads. They talk about something called red light, green light, which is basically if you're going to spend something, don't just spend it and leave it. Spend it, sort of like green light, like you spend it, and then do red light. If it's not working, stop spending, reduce spending, or just get rid of it. But if it works, then just keep spending more in it. So the particular thing this comes up a lot with our marketing campaign. So I went through that last week about the different marketing campaigns I did, and also about how to plan for a marketing campaign. As in, if you wanted to, for example, give a bunch of Canada flags to everybody on Canada Day for all your clients, and you want to see if that works, you allocate a certain amount of money, then you spend it, and then you give it to all your clients and you see how it works. The idea here is that, let's just say you did that for the first year and you didn't get any leads and nobody talked about, nobody thanked you, who cares? The next year you might want to consider it wasn't really a good marketing campaign, so you don't want to do it again. However, let's just say you did do that. You sent a bunch of Canada flags out to everybody, and then you got like 3 leads and 1 closed deal, and everybody was like, this is amazing, thanks so much. Then you might want to consider for the next year, here at the green light, that, wow, maybe I should double down on this. And now instead of just Canada Day, I'm going to give everyone a Christmas present. I give someone like a back to school fall thing, and in the spring we'll give them like seeds or something like that. And then like you double down on it because it works. And so it gives you the green light to keep going and to keep spending money on whatever it is that your campaign was doing. And so that's the idea about red light, green light. So you always want to be monitoring your marketing campaigns and what you're spending. This is a quick tip that I learned from somebody. I forget who, but their suggestion is to periodically call up the credit card and say that it's stolen, either suspend it or just say that it's stolen and it's gone. The advantage of this is that, especially in real estate, there's no shortage of vendors trying to get your money, whether it's from leads or websites or like, Canada flags, whatever it is. There are a lot of ways to part us with our money. And so sometimes there are credit card charges, we don't remember what they are. And you sort of, you get really excited during an expo or something like that. You bought something and now it's just charging you $20 a month. Maybe it's just like Boom Boom or something. And it's like a video sending type of software, but you haven't used it in 4 months, that kind of thing. So the recommendation is just cancel your credit card or suspend it, and then see what comes up. Because then the website company will call you up, the VIP card company will call you up, other people will call you up and say, hey, where's your new credit card? And then you can make a decision then whether or not that particular expense made sense for you. Number 4, variable versus fixed expense. If you don't know what variables versus fixed expense are, variable means that it's variable, which means it changes for every time like you get a deal in a very simple case, and fixed expenses is something you have to always pay. So fixed expenses, for instance, your insurance, your membership for TREB, that kind of thing, you have to pay that every single year. There's nothing you could do. Whether you do 1 million deals or 0 deals, you have to pay that. That's called a fixed expense. A variable expense is an expense that changes depending on the amount of business that you do. So for example, if we're talking about staging, only whenever you get a listing that you spend, let's just say $1,000 on staging. So you're not always spending that money, but you're spending it every time when you get a particular deal. In general, you want to cut down on fixed expenses and increase variable expenses in general. So the reason why that is because as your business grows, your variability for the expenses here can grow. So again, let's talk about staging. Pros and cons about that. But if you get a particular listing and you want to spend money in staging, you can pay the money. Let's just say it's $1,000, very easy to understand. The alternative with fixed expenses is if you wanted to buy your own furniture. So now you buy your own furniture, you buy your own beds, you get your own storage. Let's just say it costs you like $5,000 or something like that. No matter how much business you have, you still have to pay that $5,000 in expenses. Or you do variable, in which you have to wait until you get more business coming in and then it pays for it. So pros and cons to both. There's not really any right or wrong answer. The reason why you would do the fixed expenses in the case of staging, like for myself, is because you have enough volume and you want to use the furniture for other stuff. Maybe you want to start a staging company, maybe you want to do other things, so that's okay. But if all you did was take all the furniture and just keep buying it and then keep storing it, buying it, storing it, and not really getting that many listings, then it may not have made sense to do the fixed expense method. You should have done the variable method, pay for it whenever it's done, and then forget about it. So pros and cons with that. In terms of staging, some people actually use the staging equipment. So I know of a lot of realtors that do that. Basically, they just use the nice paintings and nice furniture or whatever it is in their house. And then when it's time to stage, they may not have that much business, but they save money on the variable because they don't have to pay somebody else to do the staging. And then so whenever they have a listing, it's like their house looks very bare because all the furniture and paintings and everything are gone. But they save money that way. And there's nothing wrong with that method too. So it depends on how you want to do that. Lastly, I just want to quickly talk about brokerage split. Same thing here. It's not just about reducing the amount of split that you're paying your brokerage. Like this is also this could also be a variable or fixed expense. It depends on your particular deal. Some, for example, have a desk fee where you're paying like $1,000 or more per month. And that happens no matter whether you do business or not. And that kind of sucks if you don't do any business. But that's pretty good if you do a lot of business, right? So that's good for the brokerage split. So other ones have a variable brokerage split such that you only pay whenever you do business. And so that's like another method that you could do. So the other thing that's not just about the cost. So one part's the cost element, which is the fixed versus variable. So the fixed, again, desk fees, monthly fees, technology fees, whatever you call them. So there's that. And then there is the variable cost, which is typically whenever you do a deal, then a certain split comes out of that. And then you have to figure out, in general, does it make sense? So from the cost point of view, you can compare different brokerages that way. But the more important one, in my opinion, is to figure out the value that brokerage gives you. So if the value that you're getting from the brokerage isn't that much, then maybe you want to consider changing brokerages or sort of renegotiate. So for example, if you are paying a high brokerage fee, a high brokerage split, but they give you like an office, they give you free marketing, printing, that kind of stuff, free graphic design, then maybe it's worth it. Maybe it's not, you have to make that decision. But that's the evaluation. It's not just the cost, it's what is the value does that cost bring you? And I would say the same thing with all of these other things as well. When you're doing marketing campaigns, it's not just it costs you a certain amount of money. Like even, for example, paying money for DocuSign or Repre or whatever digital signing software that you have. Maybe you're like, man, that sucks. I have to pay up $200 or $300 a year. But the amount of grief that it saves you from driving over to the person and the amount of credibility you get from doing a digital type of signing might be worth it. You might be able to find some cheaper ones or some free ones, but maybe they'll give you more problems. Maybe they'll be a little buggier, or maybe they won't be. So those are things you need to evaluate, but it's not just a cost point of view is all I'm trying to say. Not just cost, you gotta figure out what value you're getting out of it. Any questions on profitability tips before we move on? All right. So let's go on to the PREC. So I don't know what everybody's level of production is here, but I want to quickly go through quickly. This is a topic that I'm very passionate about, but let's just go through the PREC. The PREC is called the Personal Real Estate Corporation. It's only been in existence for a couple of years. So what is a PREC? The PREC allows you to incorporate yourself and to have the commissions payable through the corporation so that now you have a corporation that can do things versus if you're personal. I don't want to get too much into the taxes, although that's what most of this corporation stuff is about. But generally speaking, when you're a regular sole proprietor, all the money comes into you personally, and then you just have to pay tax on whatever your tax bracket is. That's how the sole proprietorship works. When you have a corporation, what happens is all the money goes in the corporation, then from there, it pays out its employees, which includes yourself, and then it pays tax on the corporation. The corporation can make investments and do other things with itself so that it can make money. And then when you're ready to, and then it gets taxed at a lower tax bracket. And then when you're ready to go and it has more money in it, then you can take money out of it and then you're taxed at your regular personal tax rate. That's like the general amount. If you're confused about that, I'm happy to explain that later. But that's a general idea. So personally, again, money comes in, you just pay tax on it. It's like you're a salaried employee, you just get money, you pay it. Corporation, money goes in the corporation first, and then you take money out of the corporation as an employee, and the corporation by itself is a separate entity and it pays tax. Can you advertise a PREC? The short answer is no, you just can't. It's actually just for tax purposes. That's the reason why there is the PREC. You can't say, in my case, you can't advertise I'm Lawrence Mack from Lawrence Mack Real Estate Corporation. It's only for tax purposes. So if you want the idea that you're like your own brokerage or your own thing, your own company, you can't do it using this method. And the big question, how much should you make before you start the PREC? So when I started, people were suggesting you need to make at least $250,000 per year. You have to save at least 50K per year. I personally don't believe that, but that was the prevailing wisdom. My recommendation for most people was basically if you have stable income coming in, you should start the PREC. That was in general what my opinion was. I did not have, I don't think I had 250 or whatever it was in the year that I started the PREC. I didn't have that much of savings, but I started it. And because of that, I've saved much more than that, like 6 digits kind of thing. Like it's much, much more. It's, there are pros and cons to a corporation, which I'll go through afterwards. But generally speaking, if you have stable business coming in, I recommend that you talk to a CPA and see if it makes sense for you. So let's talk about the advantages of the PREC. Whole bunch of advantages. I personally don't think there are that many disadvantages, but there's a whole bunch of advantages. All of them come down to this thing, tax mitigation, which means reducing your amount of taxes legally. Because again, when you make a certain amount of money personally, you're going to be taxed at that tax bracket. So if you are at the highest tax bracket, you're like 50%, whatever it is, and that's what you're paying. But if you can put it all through the corporation, then now you could pay a lower amount of tax and the rest of it you can save and then build money. So that's the idea about tax mitigation. Tax deferral, it means that you're actually deferring the tax to a later time. So for example, let's just say you had 1 year where you didn't make that much money. You could take money out. Let's just say you are retired and you no longer are trading that much. When you're retired, you can start taking out money at 50K a year, whatever it is, and pay taxes at a lower rate. That's the idea of the tax deferral. There's other things, for example, for tax deferrals where let's just say you sold a property personally. You have an investment property and you sold it today in December, or whenever it is. Whenever you sell it, that's when you have to pay taxes for that tax year. However, if you had it through a corporation, the corporation can sort of defer the taxes or like half the taxes to the following year. So you get first the money in the first year and the second year, depending on when you set up your fiscal years. So there's a lot of advantages that you can do that way. So that's just tax deferral. Tax advantages. So again, it's all about taxes. I could talk for hours about taxes, but for tax advantages, there's certain tax advantages you could do with the corporation where you can legally take money out of the corporation or maybe loan money from your corporation to yourself and a whole bunch of other things like that. And again, talk with your CPA or tax attorney, but there's a lot of advantages. It's not because of the fact that it's a PREC, it's the fact that it's a corporation and corporations have different rules than personal. So that's why there's advantages to the corporation. Insulation from liability. This one I'm not exactly sure on that much, but in general, corporations have a shield of liability for it. So for example, if someone slipped and fall or something and the corporation owned the company, I think they have to go and sue the corporation, which may or may not include yourself. That's different than if you owned it personally and then you have personal liability. But again, the legalities of that, talk with the appropriate professional on what that means, but there is some liability mitigation from the owning a corporation, which helps. Business planning was a big one. That's one of the reasons actually why I had the PREC at the beginning, even though I could not justify it financially. From a business planning point of view, I thought it was very, very good. What it means from a business planning point of view is that the money comes into the corporation, and now the corporation has to pay you as an employee. It's a lot different from a mindset than when a whole bunch of money comes into your checking account and then you go and spend it because it's like a giant piggy bank. You don't really know how to allocate it. You don't, like, you think it's all yours, but when you start to separate it and or you get a CPA to start managing your books, now you have a corporation, and the corporation pays you, whatever money that pays you monthly or weekly, kind of like an employee. So now it's like the corporation is paying you like an employee, and so you don't have to think about your personal expenses because you're, okay, as long as I make a certain amount of money, that can go pay for my mortgage and that kind of stuff, and then the corporation runs itself. So I like the idea of the separation of the corporation and your business practices and your business, and your business compared with your personal. I thought that was actually very good from a mindset point of view. Going back to the audit. So the thing mentioned before was that the higher chance to audit as a sole proprietor, which is true, at least anecdotally from my CPA is what I'm going to say. So similarly, the insulation from audits is a higher shield as a corporation, which may help because it's just a corporation that has to get audited if it gets to that point. Again, I haven't been audited before, which is great, although there are different levels of audits, and so that's good. Hopefully, I never have to go through that, but that's what that's about. And the most important part here, this is one of the reasons why I had the PREC 2. It's because of portability to other brokers versus a sub-brokerage. So there are other methods of having a corporation previously. Previous to the PREC, you can start up your own brokerage. So you can become a broker record, or you can do something called a sub-brokerage, which basically means you are going to be you're registered as a brokerage, but it's underneath the brand of someone who's bigger. So that was called a sub-brokerage at the time. The main problem that I found was that the sub-brokerage had a lot of tying to the main brokerage in that I could not change brokerages. But once you have the PREC, for example, you can even move pre-construction, you can assign that to the PREC, that kind of thing. So if you did move, now you move and then the PREC still gets paid and you still get paid and you're at a new brokerage if the old brokerage wasn't very good for you. And that's a big advantage. As I said before, a lot of people change brokerages often. It's very rare someone stays at the same brokerage for like 20, 30, 40 years. Very rare. Most of the time they change maybe once or twice or 5, 10 times or whatever it is until they find the right fit for them and then they stay there. That's typically what happens. But the idea is if you had the PREC, it gives you that extra ability to do that. You can also do other planning too with the PREC. So for example, I'm going to go back to a couple of things like tax deferral because I can't talk any. I just love the PREC. I love corporations and I love talking about taxes. But talking about tax deferral. So for example, another advantage isn't necessarily that you're making less money. Maybe you make more money. So for example, let's just say in one particular year, you sold your personal investment property and also you have like 4 pre-constructions that all close in the same year. Like, let's just say it's 5 years from now. So 5 years from now, all of a sudden you have a whole bunch of cash coming in. You're definitely at the top tax bracket. Well, all the money that you made during that year, you might as well put that into the PREC so that you can take that money at a different time instead of paying at the top tax bracket. So that's another advantage. And lastly, yet another advantage is the reason why I recommend a PREC for some people is because they actually have a full-time job or a part-time job. And the reason for that is because you have a certain amount coming in. Let's just say you had like 100K coming in for whatever job you had. All the money that you make for real estate is going to be on top of that. You have to pay tax on all of that. So let's just say you made $100,000 in your regular job, and now you made $100,000 in your real estate job. That's $200,000. So when you're at the top tax bracket, you're paying a lot of tax there, which means that you can't defer or save any of the money that you get because of your salary, because that's your job. It just comes in and it just goes in your account, and you got to apply that for taxes. However, all the stuff with the real estate can definitely go into the PREC and just sort of save there, save money, use that money to go buy an investment property, eventually make some more money, and then you take the money out eventually down the road when you're retired or whenever it is. And so that's one of the advantages that I really suggest having if you have a full-time job that is that stable and that you make enough for real estate. I mean, it's kind of like the same thing in that you're making more than say 200K, 300K, 150K, whatever it is. It's kind of like the idea, but you're sort of guaranteed that base of whatever your salary is. And so you really need to figure out what to do with the excess amount, especially if it's like you and your spouse are already making like a certain amount for the household already very, very well. So the extra money, you might as well put that in a corporation and try to increase money that way. So that's all the advantages of the PREC. Let's talk about the disadvantages. What are the disadvantages? Honestly, I can't think of many. The main disadvantage are two things, in my opinion. One is the cost, and the second is the mental taxing of the fact that you own a corporation. So ignoring the mental ability that, oh, I have to deal with the corporation, which is true, whether you get CRA notices and maybe you have to deal with audits, that kind of stuff, separate bank accounts. So let's ignore that part. Let's just talk about the costs, right? A lot of CPAs, I think at the end of the day, $2,000 to $3,000 per year is probably what you end up paying somebody to handle all this. So if that's all you're paying, the question is, does a PREC get me more money than like the $2,000 or $3,000 I'm paying a CPA to deal with this on a yearly basis? That is my personal line to figure out whether or not you need a PREC. So again, other people are like, you need to make more than say 200,000, you need to be able to say 50K per year in your PREC, that kind of stuff. I mean, that's great. But in my opinion, if the PREC makes more, let's just say it costs you round numbers, $3,000 per year to manage the PREC. If your PREC makes you more than $3,000 at the end of the year, every year, then doesn't that make sense that you should have the PREC regardless? Like, I'm just, from a logical point of view. So that is my line, which is just, hey, if it makes more than if it makes me $3,001 every year, then obviously it makes sense I should just do the PREC and move on with my life. But I guess that calculation is up to you about whether or not that makes sense. Other advantages that some people have talked about, whether it's tax splitting or expensing and that kind of stuff. Honestly, you can do that normally with your sole proprietorship. So I'm not really going to talk about that because you can do that anyway. It's a business entity. So that isn't really a specific advantage of the PREC. That is just an advantage of the business in general and keeping track of your books. Okay, that was a mouthful. Anyone have any questions about the PREC or anything else? Oh, I see a chat. Would you recommend taking money from a line of credit to fuel your business? Yes, I would.